I'd like to teach you another financial truth from the Wealth and Wisdom Institute, and this one pertains to average rates of return and what money managers and stock salespeople and bond salesmen have been telling you for years, and that's that average rates of return on variable investments are going to outperform fixed or possibly indexed investments, or another way of saying it is it's worth taking the risk of losing some of your portfolio because the returns are going to be higher over time. Now, if something you thought to be true weren't true, when would you want to know about it? That's kind of cliche, but it's very apropos in this situation because we have been taught for years and years and decades that average rates of return in variable investments are 7 to 9 or 10 to 12. Certainly we've been taught that it's worth taking the risk to have a diversified portfolio or to be in the market, because certainly you won't grow your money the same way inside of fixed or index products. What I want you to do is make your decisions based on the truth. So let's look at the truth, and you will be able to know at any given time from here on out when somebody's lying to you or not showing you the whole truth. So, average rates of return. We are told that variable investments will outperform fixed or index investments for the long term if you leave the money in long enough. So let's just go back to 1929. I think that's plenty long enough. And we're going to look at the average rates of return in the Dow Jones Industrial Average from 1929 to 2008. Now, first thing to note, you put in $1,000, the illustration or the prospectus is going to say you'll end up in 2008 with $133,000. The first thing to note is that's only a 6.33% rate of return. Now, whoops, that might surprise you, but let me just pull this back up here. That may surprise you a little bit, but it doesn't surprise Harvard. Harvard did the research and they looked at American money managers and found out that on average they make you about 7% after their fees. Also, research has been done to show that 80% of money managers do worse than the S&P 500. So if you were going to have variable investments, you'd be better off leaving it in the S&P 500 than working with 80% of the people out there charging you money to manage it for you. But that's not the point I really want to stress, because this is not the most shocking point. The most shocking point is that average rates of return have absolutely no meaning for somebody who's trying to save money for retirement or accumulate cash. The only thing that matters is how much money you end up with. You see, average rates of return come from looking at all these years, adding together the negative and positive returns, and then dividing by the number of years. But then someone's going to run an illustration for you that says you actually make 6.31% for the rest of your life. That's not the way it works when your money's in the market. When your money's in the market, it goes up and down. If you lose 50% of your money and go from 100,000 down to 50,000, you now need a 100% return to make it back, not just a 50. So the actual performance or the actual rate of return over the entire history from 1929 till 2008 of the Dow Jones Industrial Average is only 4.33 taxable. Now that's not better than the safer alternative. And the difference between 6.31 and 4.33 is shocking. The difference between 4.33 and the 7, 8, 9, 10, 11, 12 that we're told that mutual funds and variable investments can earn is very shocking. The real difference, and this is where Americans are hurting right now, is that you will have over 70% less money. It's not the interest rate. The way compound interest works, the actual performance of the variable investments have 70% less account value than what was shown or what would have been shown on the prospectus. The only thing that matters when you retire is how much money you have over here and then beginning to live off of it. So the next time somebody tells you they can earn you 7, 8, 9, 10, 11, 12, or that mutual funds make 10 to 12%, or that you should use a variable diversified portfolio because over time, if you leave it in long enough, it works better than fixed products or index products. I want you to know that you are being lied to, and that's not necessarily true. You probably need to make 14, 15, 16, 17% average to outperform much safer strategies.